Preparing for a finance analyst at Fidelity Investments interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to become a finance analyst at Fidelity Investments. I would summarize my background through analytical training, practical experience, and motivation. My coursework and projects strengthened my accounting, Excel, and financial modeling skills, while internships taught me to validate data and communicate conclusions clearly. Fidelity appeals to me because it combines asset management, retirement, brokerage, and technology with a strong client focus. I want an analyst role where accurate analysis supports better decisions, and I can keep developing through exposure to complex financial products and experienced teams. While answering, connect your education, analytical experience, and interest in financial markets to Fidelity's diversified businesses, client-first culture, and emphasis on accuracy, collaboration, continuous learning, and long-term career development. Question 2. Why Fidelity Investments rather than another financial services firm? Fidelity stands out because its scale is paired with a long-term ownership perspective and a strong focus on serving individual and institutional clients. I am attracted to the combination of asset management, retirement solutions, brokerage, and technology, because it creates a broad analytical environment. I also value Fidelity's reputation for investing in employees and innovation. Rather than pursuing finance in a narrow silo, I want to understand how analysis influences products, operations, risk, and client outcomes. Make sure to cover Fidelity's privately held structure, broad financial services platform, technology investment, customer orientation, workplace culture, and how those attributes specifically support your analytical interests and career goals. Question 3. Walk me through the 3 financial statements and how they connect. The income statement measures revenue, expenses, and profitability over a period. Net income then flows into retained earnings on the balance sheet. The balance sheet presents assets, liabilities, and equity at a point in time, while the cash flow statement reconciles beginning and ending cash through operating, investing, and financing activities. For example, depreciation reduces earnings but not cash, so it is added back in operating cash flow. The statements must remain internally consistent. In your answer, explain the income statement, balance sheet, and cash flow statement. Show how net income flows into equity and operating cash flow, and explain why balance sheet changes reconcile accounting earnings to cash. Question 4. How would you evaluate the financial health of a company? I would begin with growth, margins, and earnings quality, then examine whether profits convert into operating cash flow. I would review liquidity ratios, debt maturities, leverage, interest coverage, and working capital trends. Comparisons against the company's history and relevant peers help provide context. I would also investigate unusual items, aggressive assumptions, or customer concentration. A healthy company is not simply profitable, it should generate durable cash, maintain financial flexibility, and earn attractive returns on invested capital. Be sure to mention revenue and earnings quality, margins, liquidity, leverage, cash generation, working capital, industry benchmarks, trends, management assumptions, and the distinction between accounting profitability and sustainable economic performance. Question 5. Explain the difference between revenue, profit, and cash flow. Revenue is the value of goods or services recognized as earned under accounting rules. Profit subtracts operating, financing, and other expenses from that revenue, but it includes non-cash items such as depreciation. Cash flow measures actual cash entering and leaving the business. A company could report strong revenue and profit while collecting slowly from customers, creating weak operating cash flow. Conversely, collecting old receivables can boost cash without creating current period revenue. That timing distinction matters for liquidity analysis. Focus on timing and measurement. Revenue reflects earned sales, profit deducts accounting expenses, and cash flow tracks actual cash movement. Include an example involving receivables, depreciation, or deferred revenue to demonstrate the distinction. Question 6. How do rising interest rates affect a company's financial statements and valuation? Rising rates usually increase interest expense on floating rate debt and raise refinancing costs, which can reduce net income and cash flow. They also increase discount rates, lowering the present value of future cash flows and often pressuring equity valuations. Demand may weaken in rate-sensitive sectors, while banks can initially benefit from wider spreads. I would examine debt maturity schedules, fixed versus floating exposure, interest coverage, and pricing power before reaching a company-specific conclusion. In your answer, discuss borrowing costs, interest coverage, bond and equity valuation, discount rates, consumer or business demand, refinancing risk, and how effects vary by leverage, duration, pricing power, and industry. Question 7. What is the difference between an ETF and a mutual fund? An ETF generally trades throughout the day on an exchange at market prices, while a mutual fund is typically bought or sold at its end-of-day net asset value. ETFs often provide intraday liquidity and can be tax efficient, whereas mutual funds may offer automatic investing and broad active management choices. Neither structure is automatically superior. Costs, strategy, liquidity, tax situation, and investor objectives matter. As an analyst, I would compare total expense, tracking quality, flows, and client suitability. Make sure to cover trading mechanics, pricing, liquidity, transparency, distributions, minimums, expenses, active versus passive management, and why the distinction matters for investors and Fidelity's product or service analysis. Question 8. How would you calculate and interpret net asset value? NAV per share equals the fair value of fund assets minus liabilities, divided by shares outstanding. Assets may include securities, cash, and accrued income. Liabilities include expenses payable, trades payable, and other obligations. I would verify security prices, corporate actions, foreign exchange rates, accruals, and share activity before approving the result. NAV accuracy matters because subscriptions, redemptions, performance reporting, and investor fairness depend on investors transacting at the correct value. Explain that NAV equals total assets minus liabilities, divided by shares outstanding. Discuss valuation timing, accrued income and expenses, fair value judgments, pricing controls, and why accurate NAV supports client transactions and reporting. Question 9. What is duration, and why is it important for fixed income investments? Duration estimates how sensitive a bond's price is to changes in interest rates. A bond with a duration of 5 years would typically lose about 5% if yields rose 1 percentage point, before considering convexity and other effects. Duration differs from maturity because it reflects the timing and present value of all cash flows. Analysts use it to assess portfolio risk, compare fixed income exposures, and align interest rate sensitivity with an investor's objectives and horizon. While answering, define duration as interest rate sensitivity, distinguish it from maturity, explain the approximate price-yield relationship, and mention convexity, credit risk, portfolio positioning, and client time horizon. Question 10. How would you build a simple financial model in Excel? I would start by understanding the decision the model must support, then organize historical financials separately from assumptions and outputs. I would forecast drivers such as volume, pricing, margins, working capital, and capital spending, linking the income statement, balance sheet, and cash flow statement. I would include checks for balance sheet integrity and cash reconciliation, test base, upside, and downside cases, and document key assumptions. Finally, I would keep formulas transparent so another analyst can review and update the model. Be sure to mention clear assumptions, historical data, revenue and expense drivers, integrated statements, checks, scenario analysis, documentation, version control, and practical Excel tools such as formulas, pivots, and sensitivity tables. Question 11. Describe a time you found an error in financial data or analysis. During an internship, I noticed that a monthly expense trend did not match the underlying transaction report. I traced the variance to a duplicated upload caused by inconsistent date formatting. I isolated the affected records, recalculated the monthly totals, and asked my supervisor to review the correction before updating the dashboard. The reported margin changed modestly but materially. I then added a duplicate check and documented the data cleaning steps, which made the next reporting cycle faster and more reliable. In your answer, use a concise situation task action result structure. Explain how you detected the issue, quantified its impact, verified the correction, communicated professionally, and improved the process to prevent recurrence. Question 12. How do you prioritize when several deadlines compete? I first rank assignments by client impact, regulatory or reporting deadlines, dependencies, and the risk of delay. I break larger work into milestones and estimate the time required, leaving room for review. If priorities conflict, I communicate early with the relevant stakeholders rather than silently missing a deadline. I also protect accuracy by using checklists and focused review time. That approach helps me remain responsive without allowing urgent work to eliminate important controls. Focus on client or business impact, regulatory and financial reporting deadlines, dependencies, effort estimates, communication, escalation, and maintaining quality rather than simply working on whichever task arrived first. Question 13. What would you do if a senior colleague asked you to overlook a discrepancy? I would first verify the discrepancy and gather the relevant evidence, because an apparent error may have a legitimate explanation. If it remained unresolved, I would explain the potential impact respectfully and recommend correcting or documenting it. I would not knowingly suppress information, especially where client reporting, financial statements, or controls are involved. If necessary, I would escalate through my manager, compliance, risk, or an established ethics channel. Integrity and accurate records are more important than avoiding an uncomfortable conversation. Make sure to cover professional skepticism, fact-finding, documentation, respectful challenge, escalation through appropriate channels, materiality, control obligations, and protecting clients and the firm's reputation. Question 14. How would you explain a complex investment analysis to a non-technical stakeholder? I would begin with the decision and the main conclusion, then explain only the analysis needed to support it. For example, instead of leading with duration and convexity, I might say that the portfolio could lose approximately 5% if rates rise 1 percentage point, based on current sensitivity. I would define unavoidable terms, use a simple chart, state assumptions, and separate facts from judgment. I would finish by confirming the stakeholders' questions and any action required. In your answer, emphasize audience awareness, the decision being supported, plain language, a clear headline, limited relevant metrics, visual support, examples, confirmation of understanding, and willingness to answer follow-up questions. Question 15. What is beta, and how is it used in investment analysis? Beta measures an asset's historical sensitivity to movements in a chosen market benchmark. A beta of 1.2 suggests the asset has tended to move about 1.2% when the market moves 1%, although the relationship is not guaranteed. It captures systematic risk, not company-specific risk. I would use beta alongside volatility, correlations, fundamentals, and valuation rather than treating it as a complete risk measure. In CAPM, beta helps estimate the return investors require for market exposure. While answering, define beta as sensitivity to market movements. Explain interpretation above or below 1. Distinguish systematic from company-specific risk. Mention estimation limitations, and connect beta to portfolio construction or CAPM. Question 16. How would you analyze an investment fund's performance? I would compare performance with an appropriate benchmark over multiple periods, not just the latest quarter. I would review returns before and after fees, volatility, drawdowns, Sharpe ratio, tracking error, and peer results where relevant. Attribution would show whether outcomes came from asset allocation, security selection, sector exposure, or currency. I would also consider cash flows and market conditions. Strong performance is more meaningful when it is repeatable, mandate consistent, and achieved without disproportionate risk. Be sure to mention benchmark selection, absolute and relative returns, time periods, risk-adjusted measures, attribution, fees, cash flows, market conditions, consistency, and whether results align with the fund's stated mandate. Question 17. What controls would you use to ensure accurate financial reporting? I would use reconciliations between source systems, subledgers, bank or custodian records, and the general ledger, supported by documented review. Key controls would include segregation of duties, approval thresholds, restricted system access, standardized checklists, exception reports, and audit trails. I would validate unusual movements against source data and investigate breaks before sign-off. Effective controls are not merely about detecting errors, they create accountability, evidence, and repeatable processes that protect clients and the firm. In your answer, discuss reconciliations, segregation of duties, approvals, exception reporting, source data validation, audit trails, access controls, review procedures, documented evidence, and timely escalation of unresolved issues. Question 18. Tell me about a time you worked with a difficult teammate. On a group forecasting project, a teammate preferred a quick estimate while I wanted more validation, and our discussions became inefficient. I suggested agreeing on the decision deadline, minimum data checks, and ownership for each section. That shifted the conversation from personal preferences to shared deliverables. We used the quick estimate as a starting point, then tested its key assumptions. We completed the model on time, improved its credibility, and established a clearer workflow for the remaining work. Focus on a specific situation, the underlying source of tension, active listening, objective standards, direct communication, compromise, accountability, and the measurable outcome for the project or client. Question 19. What current financial market development are you following, and why does it matter? I am following how changing expectations for interest rates are affecting bond yields, equity valuations, and investor flows. The key mechanism is that rate expectations influence discount rates, borrowing costs, and the relative attractiveness of cash and fixed income. I would avoid making a one-directional market call. Inflation, employment, fiscal policy, and earnings also matter. For Fidelity, the development is relevant to portfolio positioning, retirement outcomes, product demand, and how advisors communicate risk to clients. Make sure to select a recent development, explain the transmission mechanism, identify affected assets or clients, distinguish facts from forecasts, acknowledge uncertainty, and connect the issue to disciplined investment or business analysis. Question 20. What questions would you ask us about the finance analyst role at Fidelity? I would ask how the team defines success during the first 6 and 12 months, which analyses or reporting processes the analyst owns, and which stakeholders rely most heavily on the work. I would also ask about the systems and data sources used, review and feedback practices, and opportunities to learn across Fidelity's businesses. Finally, I would ask what distinguishes analysts who progress quickly. Those questions help me understand expectations while showing that I care about impact and development. In your answer, prepare questions about team responsibilities, first-year success measures, systems and data, stakeholder interaction, development, rotation or mobility opportunities, and how the group supports Fidelity's clients and business strategy. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.